Well, good morning, and thank you for joining us. I'm Janine Seklich. I'm based in Chicago, and I lead BMO's U.S. agriculture team. The economics of renewable natural gas and the evolution of carbon markets have generated serious interest in the byproducts of animal agriculture. It's providing what looks to be an exciting opportunity for livestock producers to expand operations, diversify their revenue, and improve their own carbon footprint. These are complex discussions that sometimes raise more questions than answers, and we've certainly had a number of those discussions with our customers. And so we have lined up a panel of internal and external experts to help address some of those. We've got a lot to cover in a pretty short time, so let's get right into it. I'll start off by introducing our panelists. Joining us from New York is Aidan Sater, Vice President of BMO's Energy Transition Group. Aidan provides advisory services and leads transaction execution for energy-related opportunities, supporting clients as they navigate to a low-carbon economy. Aidan is specifically focused on RNG, renewable fuels, environmental products, carbon capture, and hydrogen. He has over 11 years of experience in oil and gas, including energy investment banking here at BMO, and previous technical experience in subsurface engineering roles at Canadian Natural Resources. Thanks for joining us, Aidan. From Calgary, Alberta, we have Steve Kehoe, Director in BMO's Energy Transition Group. Steve is a broad specialist focusing on new energy transition technologies, including, among others, low carbon fuels, renewable natural gas, hydrogen, and carbon capture and sequestration. Steve came into this role with a Bachelor of Engineering Science with distinction and a Master of Engineering Science in Mechanical Engineering from Western University, and he's an ambassador with the Energy Futures Lab. Prior to joining BMO, Steve worked in the oil and gas industry in production and exploitation engineering, and then spent 12 years working in acquisitions and divestitures advisory with BMO's Energy Group, evaluating energy assets and executing transactions. His work on the hydrogen economy has become an important touch point for many BMO clients, government, and agencies. Thanks for joining us, Steve. From Madison, Wisconsin, we are pleased to have Jordan Hamiden, Partner and Energy Group Chair at Michael Best. Jordan helps energy companies and other sophisticated businesses structure and contract for large-scale capital expansion and procurement, including representation in siting and certification cases for large power generation facilities. Electric transmission lines, private energy facilities, and large agricultural projects. He also represents clients in the transactional and regulatory aspects of purchasing and developing renewable energy projects, including wind, solar, and biomass. Jordan is known for his ability to achieve consensus among various stakeholders, as well as his creative solutions in resolving disputes and completing transactions. His practice also includes a wide range of energy-related procurement and construction matters, including contract negotiation, contract administration, bid protests, and dispute resolution. He guides public utilities through rate making and other regulatory matters by establishing close relationships with regulators, yet never compromising his ability to fight for his clients. Thanks for joining us, Jordan.
Thank you, Janine.
Joining us from New London, Wisconsin is Dan Wenzel. Dan is a founding partner of the Dairy Business Consulting Group. He has been working in the dairy industry since 1986 and has been a consultant working with large modern dairies since 1990. Dan provides financial and business management services to dairy farms, including budgeting and monitoring, analysis, benchmarking, expansion planning, workout scenarios, and expert witness consulting. He also helps his clients with on-farm communication, farm transfer preparation, and advisory team meetings. Raised on a dairy farm in Manitowoc, Wisconsin, the Canadian comes out every once in a while when I try to say those Wisconsin names. I got it. Dan graduated with honors from the University of Wisconsin-Madison with a Bachelor of Science degree in Dairy Science and Agricultural Economics. And last but certainly not least, from Marshfield, Wisconsin, we have Brad Goosey, Senior Vice President and Agriculture Relationship Manager here at BMO. Brad manages a portfolio of production agriculture customers with a focus on dairy accounts. He has 10 years of experience in dairy nutrition and over 25 years of agricultural banking, 21 of which have been here at BMO. Brad is also very involved in the industry and in his community and is passionate about farm safety and mental health. He served 21 years in the Wisconsin Army National Guard, retiring in 2004 after a successful deployment to Afghanistan. Thank you for your service, Brad.
Thanks for being worth it, Janine.
Thank you. He holds a bachelor's degree from the University of Wisconsin River Falls, and would note that he saw his first biodigester in 1981 and has been involved in financing the earlier round of digester projects. Well, I am excited about the breadth of knowledge and the perspective that we have here today. I've got some questions to get us started. I would encourage you, if you have questions, please type them in the chat box. We'll get to as many as we can today, and we'll follow up later on the rest. At the end of the webcast, you'll also see a survey pop up once you log out, and we'd really appreciate your feedback on what you see today and what things you might look to us from in the future. Okay, so let's get started. Let's start with what's driving all of this activity and the carbon market in general. So Aidan, maybe we'll start with you. What is the carbon market? What's trading? Who's buying? How do they connect with sellers?
Good question, Janine. I'm sure everyone's heard a variety of different concepts and names and voluntary and compliance and fuels. And I think to simplify it all, it's just important to simplify compliance. And the right way to think of that is people that need to do it or participate in that market, and voluntary, people who choose to participate. And so when we think about RNG, there's two types of credits that are really important. There's the RINs, or what's referred to as the Renewable Fuel Standard, which is a federal program administered to the EPA. And then the California Low Carbon Fuel System, which is a state program that's administered to the California Air Resources Board, often referenced as CARB. These programs apply to fuel importers and refiners. So think of people that are making your diesel, your gasoline, or importing it from other countries. And they're obligated to participate in this program. So many of the largest refiners in the world, like Shell, like Valero, are purchasing credits. And there's a variety of parties that are generating them. And so these folks connect through third-party intermediaries directly in order to facilitate the buying and selling of the credits. And that's how the market works in a very short, kind of in a nutshell, if you will.
Okay, so what has that value of those credits done over time? And how did the value of the different types of credits compare?
It's a good question, too. So the two markets we talked about, and it's important, we're only talking about a subset of these. We could go on for hours and hours if we were going to talk about this one topic alone. So the LCFS market, so that's the California market we just talked about, has gone through some pricing pressures. So over a couple of years ago, you would have seen the price being about $190 a ton. That's come down to, about less than $100 a ton. And this has been driven by the large volume of renewable products that have come online. So the reason for the program is to incentivize renewable products like renewable natural gas to enter the market. But there's been a lot of these products that have entered today. And so CARB, if you remember, the California Air Resources Board, who administers the program, is contemplating some broad scale changes in order to support that pricing back up. There's no magic, 8-ball to identify exactly where they go. But they're working towards providing some pricing support to that program. RINs, which is the federal level program we talked about, have gone through some pricing volatility, but have actually been quite stable over the last while. So there's a bunch of different RINs, and I won't go into it. But the one that you want to keep an eye on if you ever go to the EPA website is the D3 RIN. So Delta 3, that's the one that's most applicable to RNG producers.
Okay. And that's, that kind of leads into a question I was just about to ask, which was how transparent is that market for credits? But it sounds like where do we find these values? It is the EPA website generally?
That's a good question. Yeah, the EPA website provides you some real-time pricing where people who are trading will report in the pricing on a weekly basis. So you can see some weekly averages on their website. And then the California Air Resources Board, again, they provide some weekly pricing as well, which you can find on their websites.
Okay, and are those really the only two? I know you've already sort of mentioned there are a number of others, but can you give us a couple of examples maybe of other?
Sure. Yeah, so look, there's more markets coming online. Two of the major ones that are coming online in 2023 are going to be Washington State and the federal system in Canada for folks that are near or proximal to the border. But there's also programs in Oregon, in British Columbia, if you're on the West Coast or in the Western Interconnect. And further, there's programs that are voluntary. So what's happening is parties out there, just corporations who consume natural gas, will enter into offtake contracts similar to the renewable power market, where they will go to someone who's generating renewable natural gas and say, I will buy it for this set price for an extended period of time, which it just completely bypasses the credit market altogether.
Got it. Okay. So maybe, Steve, that leads to a question for you. I guess, obviously, there's a supply and demand sort of built into the value of these credits and for the gas in general. I guess, what's the size of the market for RNG? How many digesters can we build? And do you think there's a risk of saturation?
In terms of saturation, I don't think it's a risk. One of the stats I heard was that if we were to capture all of the renewable natural gas we could in North America, from all the sources, so cattle, dairy, municipal solid waste, it would amount to about 2 BCF per day. And when you think that North America consumes about 115, 120 BCF per day, it's a drop in the bucket. So I think from the perspective of people who own these assets, so think dairy farmers, you've got an asset that's very limited, that's going into a market that's very broad. So I would say there's not a risk of it being saturated. It's almost the opposite.
That's very promising for the kind of longevity of these projects, for sure. How does the work that you're doing today compare to the work you did in the heyday of conventional oil and gas?
I think it's very similar, and we see it as a very similar market. So when we would work with oil and gas companies, we typically worked, the area I worked in, and Aidan was in that for a bit as well. They're relatively small companies, so junior, mid-sized. And they essentially worked as like the R&D arm of bigger oil companies. So they would go out and develop properties. They would get them to a point where they were sustainable and commercial, and then they would want to be sold. So we would help. We would act as essentially like a real estate agent. So we would represent them. We would help them build a marketing plan, and then take it to market. And we also have the relationships with most of these companies that would be buyers. So larger oil companies, private equity firms, midstream companies sometimes. So we would have those relationships, and then we would help these oil companies get the best value for their asset that they had built up. And then typically what they would do is that after they sold that, they would go start up another one. So it was sort of a running treadmill that way, and it worked really well. So we see this as a really good analogy with what's going on with farming right now and with the whole renewable natural gas space. So dairy farmers, cattle farmers, they've got the asset, and I'm sure many of them are being approached right now by different developers. And as many of them are clients of the banks, we want to make sure they get the best possible deal they can. So that's sort of the situation we see, is where they've got the asset, and you've got to maximize that value.
It's great, great context. And I think that kind of ties or leads over nicely to talk to Jordan, our attorney on the panel. Jordan, you've been working in this space since very early on. And from your standpoint, how have the structures of these contracts or projects evolved?
I think it's a very interesting history, Janine. What we saw at first, I'll call it the tale of two developers. We saw first very sophisticated subsidiaries of established energy companies coming in, targeting farms that already had digesters.
Okay.
So that's what I'll call the low-hanging fruit. And these sophisticated companies who made this their target were very successful at sort of rolling up these larger farms that already had digesters and structuring the deals so that the main compensation to the farm was in the form of a fixed rent amount under the lease. And then there would be a separate manure supply agreement. There wouldn't be separate compensation under that, so that the rent amount, which remained unchanged except for maybe an inflation escalator throughout the long term of the contract. The compensation was fixed. At the same time, there was sort of an explosion of developers who mean very well, but who were very thinly capitalized. Now, one would think that farms would take a look at these folks and just say thanks, but no thanks. But what they were good at is sort of promising the moon, saying, hey, we're gonna build either the biogas upgrade facility if you already have a digester, or the entire capital expansion with a digester and the upgrade facility. And we're going to have, I'll say loosely, a partnership, and we're going to give you 50% of the net profit of the project, which is extraordinarily generous for the person who's taking the technology and capital risk to offer. But the problem was they didn't have the money behind them. So I think a lot of farms got caught up in, negotiating contracts which promised the moon, but where there wasn't enough capital to back it up. And then these developers were left scrambling, not only for capital, but if they could get it sort of in the back of the queue for procurement of the long lead steel items, which was especially challenging during the supply chain crisis, which we're still feeling the effects of. So the evolution from there, I'll say, has been sort of a movement to the middle, where most developers, including sophisticated ones, are now offering a percentage of EBITDA from the project, certainly not 50. You're seeing more around the range of 10 to 20% to the farm. Oftentimes now, even with the price pressures that Aidan talked about, you're seeing the developers willing now to spend pretty significant amounts of money to change the manure handling aspects of the farm. If they're betting on sand, for example, to move to solids and to make the investment for the farmer in manure, separation equipment and drying equipment to make that possible. And, maybe deducting some of that from the percentage that the farm will get over time until it's paid back. I've also seen an increasing willingness on developers to leave the digester and the manure separation equipment behind at the end of the term. You won't see them leaving the biogas upgrade or compression equipment. That's on a skid, that's very portable. It's going to go away at the end if they don't continue the relationship. But I think farms are now seeing the potential to have very nice capital upgrades, including in some cases switching from flush systems to vacuum systems for manure collection. And that's a big plus for the farms. So that's where I'm seeing these deals sort of converge to. And, farms are sophisticated too. These are sophisticated business people. Mm-hmm. They do want to focus on milking cows because that's what they're in this for. Mm-hmm. But I think most are starting to see that, taking a fixed amount of rent for the project isn't enough skin in the game for them. And they're willing to take a little bit of a chance on price volatility and to, arrange their compensation as in terms of how much the project is earning.
Right. So, that's a great point. So is there a process by which a producer could evaluate the offer? Is that something that you, as their representation or as someone who's helping put that deal together, is there a way for them to say this is a good deal or I'm leaving something on the table? I guess in some way you always run that risk, but, I guess, are there enough comparables out there to get a sense of that, do you think?
Well, I think this is a challenge. First of all, I'm pretty straightforward up front with my clients that, I've got too much to do to be able to keep up on the economics of where the offset price of where the credit prices are, where they're moving, whether or not, because developers are going to be very close to the vest about what their pro formas look like and what sort of profit proposition there is. And I don't know what the cost proposition is. So I really don't feel qualified to tell my clients from an economic standpoint if this is a good deal. That said, I work with partners in consulting and engineering firms who are good at keeping up on these things and who can give at least a gut check back of the envelope formulation to the farm about how good of a deal they could hope to get. And for something less than $10,000, they can have an engineering firm do a preliminary carbon intensity score evaluation, because the value of the renewable natural gas is first and foremost determined by your carbon intensity score. And sort of counterintuitively, the lower that score is, the better off you are, right? It's all about how much methane emissions you're avoiding. And so, again, the lower the score, the better. So having an idea of what that score is and what the value is of how much gas you're going to produce at that score can be very powerful for a farm in terms of getting some estimates about what they hope to get paid and what they ought to get paid. I think, the other thing too that pops to mind here that I think farms need to be very careful of is making sure that the developer has good relationships with finance sources. And most of these deals we're seeing now, and this is another way they're evolving, most of these deals up until last year were very equity heavy, private equity heavy. So we're looking at 80, 90% equity. And now that ratio is coming down as banks get more comfortable and more interested in this space. And of course, the cost of that debt is going to be a lot lower than the cost of equity. So that's freeing up some money. Another thing that farms ought to be aware of is that in the administration's Inflation Reduction Act, which was just signed into law, there is an investment tax credit now that can pay up to a third of the capital costs of these projects. And you can imagine that dramatically changes the pro forma for a project. And I think farms need to be aware of that when they're negotiating for how much of that largesse they're going to be able to get as well.
Right. Steve, I don't know if you maybe want to chime in on this. You've looked at a number of contracts and talked to a number of producers. Do you have some thoughts just to maybe to add to what Jordan's outlined?
Yeah, exactly. And that's the kind of advice that Jordan was talking about. It's very similar to what we have done in the energy space previously, and we're definitely getting a lot more comfortable being able to do that now. We've seen a number of these contracts, and we can see where what the difference is between some. I mean, you primarily got, you could have at one end you could have 100% owned and operated by the farmer, where you put up all the capital and you'd operate it and take care of your own offtake agreements. I don't think anyone wants to do that. I think they all want to stick with their primary business, which is producing milk. The other one would be sort of a JV, where you sort of a partner with the developer. I haven't really seen any of those, but by far the most common contracts are the developer will come and put up all the capital. And as Jordan mentioned, there's that, it's about a 30% tax credit now. So with the Inflation Reduction Act, RNG biodigesters are now equal to solar and wind developments. So it's the same investment tax credit that's available there. There's another new markets tax credit that can be available as well, that can cover up to another 20%. So it's possible that these developers are getting up to half of the capital covered through tax credits.
Right.
Which it's important for the farm to know, because it does change the economics, and then it also makes it very important for the farmer to understand that you can get a fixed fee, so basically a dumping fee for your manure plus some kind of a rent. But I think it's more important to try and negotiate in some sort of a revenue sharing agreement, whether it's revenue sharing directly or a royalty payment. So those are a lot of the factors we like to consider, I guess, when we'd be reviewing these contracts.
Right. Okay, great. Thank you. Maybe turning, just kind of switching a little bit to the operational aspect, Dan, of what this means, what these projects mean for the farm and for day-to-day operations. What are you hearing from your clients? What are some of the biggest frustrations maybe that you've heard from your clients when it comes to the construction phase of these projects?
In my experience with the construction phase, I've had a couple that have gone okay, and I've had some that have had some frustrations. Basically, the timelines and deadlines, the construction site, the management of the construction site is different than what the farm is used to. The farm likes to get it done, and I think there's just a lot more corporate and bureaucracy in some of the construction design and planning. Another thing I've run into is the gas company forgetting what they agreed to. In some cases, it's been quite a time has elapsed since this thing was signed versus the construction. Sometimes people have changed. An example is there was supposed to be a pipe buried to the farm for gas, and the gas construction crew said, well, that's your responsibility. And the farmer said, well, that's your responsibility. They dug out the fine print, and the farmer was right. So it's really important to know what you're agreeing to. And I've run into that a couple times. Another thing I've seen is, the gas company may be installing some pipes and pumps. And a lot of times I'll see the farm is responsible to the digester. And then after the digester, the management is at the gas company. But the gas company may install pumps that are too small, pipes that are too small. Farmers saying that's not going to work. And lo and behold, it doesn't work. I think part of it is cost cutting. Part of it is just not knowing. You're partnering with someone that doesn't know the daily operations. I've had a farm where they've had to unplug the pump several times already. And since that time, the gas companies came back and changed the pump and changed the diameter of the pipe. Also, I think it really just comes down to you're partnering with someone that doesn't understand your business. And it just takes a little bit of time to step back and communicate and make sure that that's a smooth process.
Right. Yeah, no, good considerations for sure. I guess, what are some of the kinds of things that a dairy, like you mentioned that your customers are needing to make some investments. Maybe is it, changing barn dynamics or animal movement? Or is there considerations around any of those kinds of things? Or is it pretty much just you bolt this on and it's business as usual?
Well, depending upon the more cows you have, the better deal you can get. And so if you're big enough, that's fine. Otherwise, I have people that have expanded to either get a digester or to get a better deal with the digester. So first of all, they have to be in a financial position to do that. Secondly, they have to make sure they have secured milk market to add more milk. But obviously barns and cows, but it may fall into manure storage, feed storage, and then the whole bedding situation. Going away from sand for some is a concern. So am I going to go to a screw press and a dryer? And do I need a dryer? Other people, I've decided to stay with sand and are going to have a sand separation. So I think all those things that occur with the normal expansion would occur with this, just the addition of the bedding system.
Thank you. Turning now, just sort of thinking about those investments and the capital that's required on the dairy farm side to make this happen, turning to our banker, what are some of the key metrics that a bank, or specifically BMO, is going to be looking at when it comes to financing expansion to accommodate one of these projects, like Dan mentioned? Does it change anything from a financial perspective?
Janine, as I look at things, the key metrics really don't change different from a RNG project or not. At the end of the day, you still have to ask the same two questions. Number one, what does it do to my cost of production? Number two, what does it do to my balance sheet? And when I'm talking about cost of production, I'm looking at profit and losses. I mean, it doesn't make sense to make an investment to lose money, right? So we want to make sure that we've got a profitable plan in place and that it has adequate cash flow to cover debt service. The second thing with the balance sheet, when I'm talking about that, I'm looking at, what does it do to the balance sheet? I want to make sure I pay close attention to working capital and then also to my longer term shock absorber, which is equity. Working capital, I want to see somewhere around that 2.5 months or more of working capital available after construction. And I want to see somewhere over 40% equity in the balance sheet after construction. So, understanding that, I think it was a couple of the folks mentioned the gas companies or the developers maybe putting some money into these projects that could have a significant impact on the balance sheet and make a project more viable because that money is coming in, both on the limiting the amount of debt being used, and or providing a better or stronger cushion on the balance sheet. So that's one of those considerations that you want to think about as you look at that expansion, if there is cash coming in or not for that project from the gas company.
Right. Okay, thanks for that. We've got a couple of questions coming in from the audience, and I'd like to get to those, I think. So first of all, there's a question about whether the webinar will be recorded, and it will be. We'll make sure that that's made available to you. There will be available. Okay, so here's one question. I'll ask the question and maybe see who wants to put their hand up to address it. I live where a community digester is being proposed. They will source mostly dairy manure, some poultry, and maybe others. Lots of daily trucking. A group traveled to Denmark to see them working. Is anyone aware of this concept being implemented in the U.S. Midwest? Is anyone aware of pros and cons? Jordan?
Yeah, I can answer a little bit. I'm aware of at least 2 community digesters in Wisconsin. I think there's one in Dane County, and I think there's one up in the Turtle Lake area. And you know, I think for the most part, this concept of bringing substrate in from various sources, food waste, municipal waste, and so on, has worked pretty well. Yes, it increases daily trucking, but you know, it's through the local zoning and regulatory bodies like the town boards and county and so on, where you can address those things, I think, pretty well. And remember, Wisconsin, unlike many other states, has a very well-developed network of town roads because milk has to get to market, right? So in most cases, the roads themselves are in good shape for that. Yeah, it's going to have some community impact, but there are ways to work around that in terms of establishing certain routes and time of day operations. And I think, you know, in my experience, I've spent a lot of time earlier in my career being in front of town boards, advocating for people who are trying to develop projects, and seeing communities kind of take the not here approach. And, you know, I've never really seen that work well. I think the thing that's the best approach is to work together to find a solution which allows a project to be there, but which minimizes the adverse impacts on the community. But it can work, and I've seen it work.
Thanks for that. Steve, did you have some comments as well?
Yeah, I'd just add with that. So one thing you have to be concerned with community digesters is that the feedstock, different feedstocks have different CI scores. As I understand it, dairy has probably the best CI score, probably even better than cattle. You can get below negative 200, which is, you know, so for a point of reference, if you burn natural gas, it has a CI score of about 80 or 90 grams per megajoule, whereas converting dairy to dairy waste to natural gas, you get a score of negative, say, 250. So when that factors into the carbon credit generation, it makes it very valuable. The idea is to bring that score down as low as possible. So if you can get it to 0, that's great. If you can go negative, that means you're removing more carbon than you're avoiding. So when you start adding in different types of feedstock, you can reduce that quality. So I don't know how these community digesters are set up, but if you're dumping your manure from a dairy farm, you're probably going to get one score. If you're dumping it from a hog farm, it's going to be different. And a lot of times too, I think these things will take in like food waste, things like that, and that can really degrade it as well. So it's just a consideration you have to know about, and you have to maybe be careful of. If you've got an opportunity to put a digester on your own land, and you're going to control the feedstock, and that's something else you'd want to make sure is included if it is going on your land, that there's not going to be this additional truck traffic on your roads, right?
One thing I'd add to that real quick is sometimes these community digesters are really for the smaller dairies. I've had dairies less than 1,000 cows that are getting their manure trucked. I've had one dairy that's been for over 2 years. They've had their manure picked up daily, digested, and brought back. And as another source of revenue, I have another farm that has been doing it for 6 months, and the gas company is not only paying them for the raw product per gallon for the manure, but they're also paying them to haul the manure themselves. And they have the next generation coming in with trucking, and it's very lucrative. Actually, the trucking is surprisingly lucrative. So,
great comments. Thanks, guys. We've got a question here about what % of digesters are actually able to get carb certified. Jordan, would you like to take that one?
Sure. I can't give a statistic, but what I can tell you is that all of the deals that I've done where the steel's in the ground and it's operating, I'm not aware of any which CARB has failed to certify or assign a preliminary CI score to. And I think what that owes to is you've got, investments. If the developer's building a digester for a 3,000 to 5,000 cow farm, you're talking about a $30 to $40 million capital investment. So those developers are not going to take a chance on what I'll call regulatory risk and go with a digester that hasn't been proven or that might risk not getting certified. So I think I don't see that as a big risk.
Thanks for that. Anyone else have?
Maybe I'll add on here. As you think about CARB too, look, there's a lot of volume that's going to California today, but that's not the only end market. The end markets are really developing outside of California, whether it be folks looking at voluntary offtake or alternative markets. I think we're going to see a more prominence of gas going to other places. And as a result, less dependency on the California market.
Thanks, Aidan. Another question from the audience, and maybe this, I think, Aidan, we'll start with you on this one, and maybe Jordan, you can weigh in, and Steve as well. What does the regulatory future look like in regards to dairy farms being forced to be carbon neutral? Will a farm still be recognized as carbon neutral if their assets are used to supply the digester, but a third-party company owns and operates the digester? Do farms need to hold digester ownership to get credit? I think there's a number of questions in there, but I think it's a really good one.
It's a good question. I'm going to take a step back here and just talk about it in a general sense, and I'll hand over the dairy-specific part to the folks on the line that are much better versed on the dairy side of the equation. I think where you ring fence the assets is not important. It's how they define the formula. So when they define carbon neutrality, it's what comes into the ring fence and what comes out of it, and how they define that attribute. Whether or not a third party does it is not, like, retaining ownership to the attributes or the steel is not important. It's how they're accounting for the carbon accounting around the environmental credits that are generated. And normally one would anticipate this to be straightforward, but history has kind of dictated to us that this is not as straightforward as one would think. And sometimes there's special accommodations, or certain emissions are excluded and certain items are let in. So the importance is going to be in each jurisdiction to see how they're defining carbon neutrality and what are eligible emissions and what are non-eligible emissions, and working backwards from that.
Yeah, I would agree with Aidan 100% on what he said, and I'd like to draw another distinction, which is the distinction between generating value in the form of credits that can be monetized versus just complying with an environmental mandate.
Right.
So, and this comes in, with the, do I have to own it, or do I get credit if a third party owns it? I think there's different kinds of requirements. If the requirement is just to have a carbon neutral operation, and it doesn't have to do with the generation of credits that can be monetized, my sense is most rules that will be written around that will allow you to achieve that requirement by engaging in a project like an RNG project with a third party. I think the formulation for are you complying or not with carbon neutrality will be a measurement of, what are you emitting? And however you mitigate those emissions or take them away, I don't think will be germane to answering that question. I think what's really important, and if I was going to make one point today, I want to make this, is that farms who contract with developers for these projects, give the developer what they're entitled to. They're entitled to all credits and monetization of those credits that arise from their production of pipeline grade gas from manure. But as we all know, there are many different agricultural practices and potential practices, nutrient separation and disposition, land spreading techniques and things like that, which ought to belong to the farmer. And so anytime a farmer is negotiating, don't give away all environmental credits from all activity on the farm. Just give them away for the production for what the developer is doing, and make sure that there's something in the agreement which reserves all the rest to you.
That's a great point, Jordan. I think there's a question asked here, and I think you've just answered it. It's what sort of environmental attributes are given to a dairy digester project? The agreements I've looked at typically reserve environmental attributes from the digester project to the gas producing entity. I'm concerned about loss of the ability to claim environmental attributes if our co-op or milk buyer demands it of us sometime in the future, i.e. looking for a zero carbon footprint from the dairy farm. But I think, Jordan, what you've just said really addresses that. So hang on to those, that aspect of these projects and of the practices you're engaging on the farm.
That's right. I mean, and if the milk co-op is looking for, environmental attributes that arise from the creation of marketable gas from the manure, those are already given away if you have an RNG project. And so there's not going to be double dipping allowed here. That's sort of the overall golden rule with environmental attributes. But in reserving all of the rest to the farmer is keeping the ability to create credits through other means, either upstream or downstream of the project.
Thank you, Jordan. That's great. Okay, this one is a more technical question. Dan, maybe you can take a stab at this one, and maybe Steve. Are farms in high humidity climates having to use dryers to get quality bedding? Do high temperature digesters versus lower temperature digesters have an effect on bedding quality?
I can take at the dryer. I don't know the answer. I can just tell you, I'm part of maybe, I agree with the question is I have some that are going with dryers and some that aren't going with dryers. Some feel that you need to be a certain dryness, and other ones say, well, I've toured this farm. So I actually see it split. Certainly the digested process helps if you don't dry it compared to just separating without the digester. That I have seen. But I've seen that split, dryer versus non-dryer.
Okay. Sorry, there's some great questions in here. I just want to make sure we're and I'm kind of bouncing around a little bit. There's a comment here kind of leading back to the community digester question. The farmer gets a fertilizer product back, which they must have different storage for. So that I think is another consideration that this audience member would like to add to that. So it's a good point. Okay, here's another question, kind of interesting. Is an RNG project easily expandable to line up with an increase in livestock numbers? So if, is there a possibility to expand on a farm down the road? I don't know if anyone wants to. Jordan?
Yes, I think the answer is yes. And the biggest indication of that, Janine, is that almost every developer that I've negotiated with wants the right of first refusal to expand their RNG project if the farm expands. So these projects are scalable. Usually they're going to put a little extra capacity in the digester if they can. And the biogas upgrade facility skid is going to have some margin of expansion ability. But, if the farm's going to double in size from 3,000 to 6,000 cows, they're going to be more than happy to come in put another digester in, increase the size of the biogas upgrade facility. So yeah, these things are scalable, and I think only limited by any impact it would have on the farm's operations or the production area and regulatory issues.
Thank you.
Janine, I see when I've seen it done, the challenge is not so much in the doubling, it's the incremental ones where you end up with expanding 500 cows and you don't have that wiggle room in your digester. Because when you think about a digester, that digester is really a 21-day to 28-day manure storage facility is what it is. So if you add cows into that, you lose days of capacity, which then reduces your gas production. So you got to make sure you understand what's going on with that. So the incremental growth that we've often seen on farms is very limited. You almost have to scale in combination with the digester, or at least have that thought process in your planning.
Right. Good point, Brad. Thank you. Here's a question around capital. With interest rates rising, has private equity capital dried up for this sector, or is there still capital being attracted to this space given the growth in carbon markets? Maybe our Jordan, Aiden, who'd like to, anyone?
I'd say from what we've seen, it hasn't dried up. I mean, people who have capital still have to deploy it, and they see this is a really good market for that. I think it's almost the opposite. You're not going to see seeing a flood of capital coming into it, but I think everyone's expecting the carbon market to grow and expand, notwithstanding what we've seen with the California market. But that's really just a function more of it's just the only market that's been available, I think. And as Aiden pointed out, the RINs haven't really dropped too much. But I would say it's almost the opposite. We're going to see money being put into operations like this. And as we said right at the beginning, there's a very limited feedstock of RNG projects available. So I don't think that's really a concern.
I don't think so either. I was initially surprised by the resiliency of private equity with the price volatility, particularly with LCFS. But it makes more sense to me now, because where most of this private equity is coming from, at least in my, anecdotally, is very established energy companies, right, who are comfortable making these investments and taking the long view of them.
Right. Yeah, which sort of, leads to that. We often, some of the things that we've heard from customers as we're having conversations out there in the market about these things is, what's the long-term outlook on this? Like, we do this project, there's a change in administration, or there's a different view on these things, and does this go away? And I think what I'm certainly hearing and what I've heard is from all of you is that no, it isn't. But I don't know if anyone has any kind of specific thoughts around that. But just the, what's the long
Happy to. So, like some of my colleagues have said, right, like the RINs, or the D3 RINs, are a major source of the economic incentive here. And the EPA program has been around since 2005, just slightly changed since 2007. So if we think back to the various administrations that have come and gone, no one has fully revamped the system to the point to kind of put it out of relevance. And as we see things that have happened here, as capital is deployed here, private industry really builds a little bit of a moat around these programs, because when big refiners are investing in purchasing these things long-term, or large E&P or oil and gas companies are investing in these projects, it's pretty hard after Exxon and Shell and BP have deployed tens of billions of dollars for the government to come in and just swipe and say, hey, this program's gone away. So there is built a little bit of, if you think, stickiness around these programs with almost 2 decades of operation. And to be honest, once renewable natural gas provides a solution not only for decarbonization, but it can go into different industries that are part of the broader decarbonization. So it can be used to make hydrogen. It can be used to produce other renewable fuels. It can be used in a variety of other applications as well, where it can stack technologies. So all this to say, whether it's in the compliance market or the voluntary market, there will continue to be a large demand for renewable natural gas for the foreseeable future.
Thanks, Aidan. Here, there's one more question here from the audience. My neighbor has a large digester. They have a 30,000 propane tank to keep the digester at temperature in the wintertime. How is this carbon friendly? So I guess that's kind of an interesting question. Jordan, did you?
Yeah, my first stab at this would be that the CARB is going to account for the energy going into the project versus the the carbon intensity of the project, right? So it's, for lack of a better term, baked in. We have to remember that methane as a greenhouse gas is many, many multiples more harmful than carbon. So I think the short answer is that these projects from the standpoint of greenhouse gas mitigation are very effective, even if you have to bring in the natural gas from the gas company for the dryer to make the renewable natural gas.
Okay. Thanks, Jordan. Here's another question. What happens if the farm either sells or goes out of business in the middle of a contract?
So that's also something I've negotiated pretty heavily. And this is a difficult question in these negotiations because, again, developers making a huge investment and they want to protect that investment. But there are things that can happen, particularly on the regulatory front, on the milk quota front, and just generally on the economic front, that could result in the dairy going out of business or getting smaller. And so what I try to do most of the time successfully is come to a midpoint with the developer where we identify certain things that are beyond the farm's control and identify those as things that if they impact performance, the dairy won't be punished for that. Now, I think the developers from a pragmatic standpoint know that if a dairy is going out of business, getting anything by way of damages and a remedy is sort of like squeezing blood out of a turnip. So I think they know that. But we, for all the farms that I represent, I make sure that to the absolute extent possible, we protect the farms from things they can't control.
Right. And we're almost out of time. We've got about 6 minutes remaining. So if there are any questions, please pop them into the chat now. I think one that is kind of on my mind and one that I've heard, and I don't know, who might like to tackle this one. It's processing capacity. So how much, if we're talking about dairy expansions or we're talking about that's, accommodating these projects, how much do you think the industry can absorb? And is that going to be a limiting factor in terms of the milk side of this equation?
Well, I think there's certain times of the year and certain years where that's tighter than others. I think right now it's a little bit looser. Now requesting, I'd like to add 1,000 cows or 3,000 cows might be a little bit easier depending upon the plant than it would have been 2 years ago. But I always have that concern. If they say yes today, that doesn't mean they'll cut you back in the future. But I think it's very plant dependent. I have some plants that are very strict on no volume beyond a certain level. And I have other plants. I've got a guy approved for 3,000 cows and 1,000 cows, and the plant said, okay. So that's my experience.
Right. So it's important to talk to make sure that's an important part of the project, obviously. Yeah.
Yeah, I think you've got to, Janine, I think you've got to negotiate as part of a project. If you're going to do an expansion, you've got to make sure you negotiate a good milk supply agreement, and maybe even get somebody from Jordan's firm involved in that negotiation to make sure that you do have a home for your milk so that you can maintain that supply and continue to sell your milk, basically. So.
Right. Okay, I think we'll take this one last question here. What is the Inflation Reduction Act timeline to take advantage of the 30% discount? Is there any other regulatory changes expected in the near future? And what was the additional 20% mentioned earlier to get the project funded up to 50%?
I think the timeline on the IRA was 10 years. but would probably, I mean, they've extended them in the past, and the Inflation Reduction Act extended the previous ITCs. So there's that 10-year timeline, but I would expect that to continue. The other 20% new markets tax credit that I mentioned, that's a specialized credit. It can be applied to different projects. It has been applied to RNG projects. It's dependent on geography, so where the facility is located. So that one becomes dependent on where the farm is, basically.
Right. Okay. Okay. 3 minutes left. Here's one more question. What would define a good deal for project in revenue generated per cow? What was good in the past versus what is likely now? Does anyone want to take a stab at that one? It likely comes back to the bottom line at the end of the day, but
I think, Jordan, you've seen most of the contracts, right? So probably more than any of us, what you've seen, they're not typically tied to a per cow, but we end up by doing some math to try and get there, right?
That's right.
And what does that look like today versus what it looked like before? I've seen numbers all over the board, Jordan, haven't you?
I have, and again, what that goes to is the black box we were talking about before, which is we don't know what the cost proposition. Some of these projects, they're literally compressing the gas and trucking at 150 miles, and still the project pencils out, but it's going to be a lot less lucrative than a project where the gas line is right there. Volume is also a big determinant. I think it's fair to say I started out 2 years ago, like during the pandemic, parties negotiating things that would start to look like $70 or $80 a cow. Now I'm seeing deals pretty regularly where, we're looking at a minimum of 35 to 45 per cow. But this again has to do with all of those factors plus the price volatility that Aidan was talking about.
Right. All right. Well, we are 1 minute from the top of the hour. I think this was a really great discussion. And like I mentioned, we'll make sure that contact information is available after this, or that the replay is available if folks are interested. And if I'd like to thank our panelists for your insights this morning, and thank the rest of you for taking the time to join us and listen in. We want to remind you that we're all here to help you through that process, obviously, and we'd love to hear any feedback or follow-up questions that you might have. So there certainly is a lot of uncertainty out there today, but we certainly believe there's a ton of opportunity for primary agriculture here in this decarbonizing world, and we're really excited to help navigate through that. So with that, we're right out of time. So thank you again, everyone. Have a great day.